you're never gonna have me in class again.
We should get bonus points for attendance.
Oh,
We all
yeah.
care every day.
And
Yes, Evan, and for registration. Okay, I think I've started live streaming. Looks like I have. Yeah. Um, anyhow, I'm glad you all showed up. Uh, some students don't take attendance serious, some do. Kelly, you haven't missed a day this year, have you? Jessica, I don't believe you have in managerial.
in here, yeah.
But now taxes,
I've missed 2
you sneaked out 2 days to eat dinner.
But I had to work those days, so.
Okay. And Alexander, you haven't missed a day, have you?
Nope. The only day I missed it for financial management test.
Yeah, you had to, well, I know, but so you really didn't miss a day. You're in 2 classes. And Fanning, I don't believe you missed a day.
Nope.
And Evan, you missed one?
For that test for production operations.
Okay, because you were taking a test, not a class.
Yeah.
And Abraham, he went out and tried out for American Has Talent.
Yeah, that should be an excused absence.
Yeah.
That's important. It's an excused absence.
Work
He
related
made him
absence.
consider it. Yeah. Do you know anything yet? Do you
Mine was
to January.
don't know anything till January?
Well, I'm hoping for the best for you, man.
We're all hoping you'll make it.
Oh, so.
We're talking about attendance, and here's the snow. Never would I want anybody to endanger their lives getting to class. I'm sure there's snow on some of these hills, and then there's not snow on a lot of this pavement. I've not seen any snow on the pavement, but some of these hills and some of these hollers and forks and branches, you never know what you get. So, don't want you to endanger your life. But on the other hand, what if you're working at the bank today? Would you show up to work at the bank? They don't close for snow. Now, if you want to gamble on having a snow day off in your career, be a teacher in Mercer County. You'll get a snow day off once in a while.
I don't know, when I went there, they never shut down, except for the strike.
And if you want to sleep late, again, be a teacher. You might get 2 hour delay. Now, up here we have a 1 or 2 hour delay, 2 hours once in a while. With this new deal, I don't think we'll get it. We definitely won't get it this week because it's the last week of classes. I don't mind the delayed schedule, but I hate for classes to be canceled. Another same old story I've told you before. I drove from Richlands to Johnson City for a night class on my MBA. No matter snow, rain, sleet, or hail, I was there in class. And a friend of mine, and the professor made a comment that there was people that lived down the street in Johnson City that couldn't make it. So it depends on your determination. And so on. Same with sick days. Some of y'all can't help being sick little things. I've been lucky. I have taught for 52 years and I have used 10 sick day leaves in 52 years. And half of them was when my wife had cancer for 13 years. I've been lucky. It must be smoking that's been good for me. But but everybody's not that lucky. All right, now we really are up against a tight schedule here in these 2 days. I normally like to cover on the last exam in managerial the standard cost, chapter 10. We've looked at it just for a midget of time. I normally like to cover chapter 14, cash flow, and I normally like to cover 15, ratios. Now, Alexander, you're in finance. Have you had cash flows this semester?
We're talking about cash flow. So,
Yeah. How about ratios?
yeah, we have like 12 or 13. That's like ROA, ROI, all that.
Right. Yeah, that's ROA's return on assets, ROI, return on investment. But anyway, ratios are important, especially if you're ever in a loan business and finance and banking. I was just informed that one of my accounting graduates from last year, Tanda, I believe her last name was Sutherland. She was the manager of, Bojangles? Now, Robert, are you working at the same bank she is now?
No.
It's the other Robert, Eric. I believe his last name is something like Pugh or something or other. He's working there. But you know she was working at a bank? But now, if she started out as a teller at the bank, she was making about 55 or 60,000 for Bojangles. So she had to take a pay cut, but it'd be a longer career for her at the bank. But she'll have to be aggressive because in these small bank offices, I'm sure there's a lot of. Robert, you work at a bank some, don't you?
Yeah. A lot of.
Have you noticed any backstabbing?
No. Never.
Because you're part time, right?
Yeah. I mean, like, they won't teach me how to do certain things. I feel like it's because they're trying to better themselves in the company. Like, they're always trying to do, like, the extra stuff at the end of the day just because they're trying to make themselves look better. But that's only at certain branches. Other branches, they let me do stuff.
You go around to different branches?
Yeah. Just depends who's, like, off or on vacation and stuff.
Okay, but anyway, Tanda, all I'm saying, there's a certain amount of backstabbing in these branch offices and even home offices. She'll have to stand in there with them. She was offered an accounting career at the home office for Bojangles. But she's a little West Virginia girl and she don't want to leave West Virginia. She's got a little boyfriend here and she don't want to leave that little boyfriend. So that happens. So bank will be a good job for her. All right, we've got to look at standard cost, and I'm more concerned about this chapter. We will skip the chapter on cash flow. That's chapter 14. If you're a accounting major, you'll get it in finance and intermediate. If you're any other major, you'll get it in finance. And you had it in accounting principles. This chapter you won't get in any other course, standard costing and variance analysis. All right, there's two kinds of costing we studied. That was process costing, and that was job order. This is standard. Now we talked a little bit about standard, what price standards are and quantity standards. Just some of these companies will like to compare with other companies. Now, the cost of labor in Bluefield, West Virginia. We know minimum wage is high in West Virginia, right? But total wages may be low. And of course, price standards are talking about materials. They develop standards, and I'm not worried about how they're developed by experience and studies. We'll skip some of this. All right. In this chapter, we're going to look at materials, and we're going to look at labor and overhead, and we're going to look at actual, and we're going to look at standard, and we're going to look at the variance. That's what we're going to do with these three items. These three items make a product, don't they? Let me skip through some of these. How to compute the standard quantities allowed. That's simply standard SQ, as we'll see, and SH is just abbreviation for standard quantity. Standard hours. All right. and if you multiply one by the other, you get standard ounces. Now that's standard. Anything below that, or anything below that, or above that, can be good or bad. Now labor, 1,000 direct labor hours, anything below that, or above, anything below that, if you put in 900, would that be good or bad? If it took only 900 labor hours instead of 1,000, would that be good or bad? That'd be a 100-hour favorable variance. Now up here, if it took us 1,900,000 ounces, that'd be good or bad? That'd be bad. That'd be what? 100,000 unfavorable. All right. Now, what would make, if the country as a whole had 1,000 standard direct labor hours, how come our company can do it with 900 direct labor hours? Do you have any explanation?
Process could be more efficient.
Could have more efficient machinery process.
Our employees are better skilled.
How about more efficient employees? All right. More efficient employees. My students in West Virginia. All right. In my accounting 1 class this morning. They would be efficient. Okay. Serious. They could be more experienced workers. And they are more efficient. And up here, why did we have to use 100,000 more ounces of materials?
Bad batch.
You could have got bad batches. Now you may be getting your materials for a good price, but you're getting some defective. So there's answers for why we're over or under, whether it comes to materials, price, usage, labor, price, usage. There are reasons. Now your actual output or cost is AP times AQ. Now the first one was what? Back to that other formula. You remember the standard. Was it standard what? Was that the first one? All right, here's the second one. Actual price times actual quantity. Now, if you take those two and you take my abbreviations here, you will get standard costing. The difference here is either favorable or unfavorable, and that will be your total variance, because we're going to put one more ingredient in between these two, actual times standard. So here's your standard price, standard quantity, actual price times actual quantity minus standard price minus, that gives you your total budgeted variance. That was the word I was looking for, couldn't find it. Total variance. You're going to get this before the period's over, I hope. Now your price variance is actual price minus standard price. And your quantity variance would be actual quantity minus standard quantity. So look at these to work in those other two variances. So we have a price variance. We have quantity or usage variance, same thing. Favorable, unfavorable. I'm going to try to find an example that we can deal with. Not, we'll turn to the book. Now I'm looking for numbers. Alright, how to calculate the total variance for materials. Alright, actual production, actual cost of inspection labor. Alright. Do we have enough to go on? We don't, do we? Refer to the unit standard from Exhibit 10.3. The actual results for the first week in March are alright, what page is that on? 526? Okay, we're on example 3. I'm on Exhibit 3, page 526. Whew, we got a lot of items there, don't we? Let's see what we do have on page 526, Exhibit 3. Man, on direct materials, you've got so many. You've got corn, oil, salt, golly, lime bags, direct labor. You've got labor for inspection, and machine operation, and then overhead. Total direct materials is 0.32 ounces. You've got standard price, standard usage, standard cost, and then you've got subtotal of decimal 32. I guess that's adding up all the standard costs. Alright, let's see how they go on with this. Calculate the total variance for corn. Now corn, we used 48,500 bags of corn. Now what's the standard cost for corn on page 526? Is it 18 cents? Standard cost is 18 cents. That's for 18 ounces? Is each bag 18 ounces? I don't know. They are? Alright, so we'll multiply by 18 cents. See what that gives us for standard. That's actual bags. That'd be actual quantity times standard price. Somebody give me 48.5 times 18. I hope I broke this down okay. I don't know. How much?
8730.
8730? Is there a decimal in there somewhere?
No.
1,000? That's a pretty big variance. Could be though. Let's see. How to calculate the total variance for materials, actual cost, and standard cost. Corn, actual cost, I didn't see that. Now, did we get 87.3? We got that. So we had to know the actual to get the variance. So the variance is 29.70 unfavorable. We should have paid only 87.30 for corn, but we're paying 11,700 for corn. Why? What could account for that? Why did we have to pay 11.7 for corn when we should have been paying 87.30 countrywide? What?
Maybe it didn't grow as
Labor went up to raise corn? That's possible.
It's in the off season, so money.
Yeah.
What?
It's in the off season to grow corn, so
It didn't grow as well.
Well, I've got a sister that lives between Lincoln and Omaha, Nebraska. Now in the summer, there's so many farms around there and cattle that her neighborhood is stinky all summer from the cattle smell. And from the bugs, the town has to come in and spray everybody's, the whole neighborhood once a week. All right? But they had a lot of rain and water and flood. And a lot of the corn land in Nebraska is sand. When the water left, it left sand. They did not raise as much corn in Nebraska this year. So, yeah, that can cause a shortage. And that's what's happened here. But anyway, here's what's important is this variance, 2970. Now that was what variance was this? 2970 is what variance?
For corn.
The total variance, isn't it? Total. Now, when we do a price variance, a PV, and a quantity variance, QV, both of those together will add up to be the total variance. So keep that in mind. That is a way to check it. Both variances will add up to be this variance. All right, to get this variance, actual price minus standard price. To get this variance, actual quantity minus standard quantity. Now what is MPV?
Materials price variance.
And what is MUV?
Materials usage variance.
All right. Now somehow or another we need to put this with just one big formula. They're giving you all kinds of little ones. We need to put it in one. All right. Here we have actual production and actual cost. That's easy to multiply those two. All right, your actual price minus your standard price is 14 cents times 780,000. All right, your usage variance is 780, take it away from 873 times 1 cent is 930 favorable. Now what's the difference in favorable, unfavorable? 20 what? Is that 2970?
Yes.
What did we have right there? 2970. Now, if y'all help me remember these figures, let's try and make this in a simple way. Now, I need a combination of these figures here. Y'all will have to help me with the numbers. Remember what the actual price was. Remember that for me. Put down actual price, 15 cents. Actual quantity was 780,000. Standard quantity, wherever they got that from, was 873,000. But now, is this actual this actual price minus standard price? Is this 1.5 cents? Right there, is that 1.5 pennies? Actual price is 1.5 pennies. Standard price is 1 penny. And make sure you've got down actual quantity of 780. Now what I'm going to try to do, if you can remember those figures for me, remember, standard is 780 quantity, or standard is 873. Actual is 780. Can you remember that for me? All right. Now here's what I'd like to do. I'd like to take the actual times the actual. Standard times the standard. Now what was actual times actual?
1.5 pennies times 780.
How much?
0.015 times 780.
Are we doing an actual price first?
Yes.
Times actual quantity? Alright, and that's 1.5 pennies. I'd have to do this because,
Yeah.
or
0.015.
this was 0.15, and what was the standard quantity?
780.
Actual?
$780.
Alright, now standard price was what, 1 penny? 1 penny times 800 and what?
73. Should just be 0.01, not 2 zeros.
What is it?
Isn't that just 0.01?
That's what I've got. Now, thanks, Kelly. Alright, now the difference here will give you TV. What's TV?
Total variance.
Total variance. Alright. Make sure that gives you what, 2970? That give you 2970? Alright, 2970, that's total variance. Now I'd like to put something in the middle here to just make this formula, all three of them together for you, and where the total variance can check it. But now, I'm not sure if it's actual times standard or standard times actual. So I'm going to try actual times standard. Now the actual is what, decimal 0.15? And standard was what? Wait a minute. Actual? We've already done that. Actual price times actual quantity. Actual. Okay, what is standard quantity? 800 and what?
73,000.
873? Now, take the difference between these first two up here and see if that gives you. Well, I think I'm doing quantity variance first, aren't I? I'm doing quantity variance first. Okay. Take 780 from 873. What do you get? 780 from 873. What do you get?
93,000.
Now multiply that by 1.5 penny. Did that give us one of our variances?
We got 1395.
Lord, that's way off. So what's wrong here? Something's wrong with the middle part of my formula. I don't want to go back to all the numbers they had. Okay, it's actual times standard or standard times actual. The only thing we have is price and quantity. This is, make sure all this is always price over here. And this is always quantity over here. Now when we get to a real problem, this should work. These 6 letters together should work, but I don't have the 2 right combination here. believe it's got to be actual price times standard quantity. That's not working. We're going to try to reverse that. I hope that works. Standard price is a penny. And actual quantity was how much? 800?
No,
So-
actual was 780.
Oh, 780? Okay, now the difference there is a half a penny. Decimal 0.15. So take a half a penny, which is decimal 0.005, and multiply it by 780 and see what you get.
I got 7,800.
7,800, was that not one of the variances?
That wasn't the total variance.
What? No, I don't want total.
That was the standard price times actual quantity.
All right, all right.
What am I trying to do?
I'm trying to get these two figures in a shorter way. I'm trying to get 3,900 and 930. Now here is a half a penny times 780. What did that give you, Alexandra?
7,800.
Well then, I can't do this if y'all keep giving me wrong answers. Now let's try this again, Alexandra. Try one half penny times 780.
11,700.
Oh boy,
It's 3,900.
so it's 3,900.
0.005 times.
0.005 times 780,000.
Yeah.
So my formula is right, but it will never be right if you all don't multiply right for me.
That is not what
Hush, Kayla.
it worked that time.
All right, now once again.
So you wrote 0.01. You didn't put 0.05.
All right, once again, I'm taking 1 penny away from a penny and a half, and I'm getting 0.05. Now you can multiply out here, Alexander. A penny and a half times 780, and a penny times 780. The difference is going to give you 3,900, which is, what variance is that, Evan? The 3,900?
I don't know. Which one was it?
Shucks, it's the price variance.
Okay.
A penny and a half versus a penny. It's price variance. All right, can you all do this? Now, does this give me 3,900? Right here, 3,900. You agree it does? That's 3,900. Now, if the actual price was a penny and a half and the standard was a penny, we know this is unfavorable, right? Now, Alexandra, I'm going to pick on you again. Take a penny, Alexandra, and take 780 from 873. 780 from 873.
You want me to subtract those two?
Yeah, 780 from 873 times 1 penny.
Not 30.
All right, that's the other variance, so I have it finally set up correct. Now, we know that that's favorable, isn't it? Now, 930 favorable from 39 unfavorable gives me the total variance. That's why I'm trying to set it up this way. So now, jot this down on your paper. Actual price times actual quantity. Standard price times actual quantity. Standard price times standard quantity. Now, if you can get those 6, you will not miss any of these variances. You will get the price variance here. You'll get the difference here as the quantity variance. And then the two together is total variance. So if you can, set up a problem like this, or we will together. Now these variances, you may have to make journal entries. I don't believe this book's requiring you to do that, but you would have to dispose of those variances. Now here we are with labor. Now labor is the same thing. You can use those same, that one formula I just gave you, use that even for labor variances. Okay, here is actual labor rate times standard. 10 minus 10. There's no variance if they're the same. I also expect to pay $1.20 per stick of butter, and I did. Thus, material price variance, this is labor rate variance, is $1.20 minus $1.20 is 0. You have no variances there if standard is actual. Alright, we're back to the same thing here. AH, same as actual quantity. Quantity is hours. SH is standard quantity. AR is actual rate. SR is standard rate. But it's the same thing as we did for materials. Do actual times actual, and then at the bottom, standard times standard. And in the middle there, please keep this part of the formula intact. Standard times actual. We can do the same thing with labor. Okay, actual here we know is actual cost of inspection, 360 hours, and the actual rate is $3.35. It says calculate the labor rate variance. Well, we got to know what the labor rate is. If actual is $8.35, did it give us standard? Don't see it anywhere, unless they were talking about the $10 here. I wonder if it's $10. I don't know. The standard quantities for inspection are computed. Labor, 1/10 of an hour, I guess, times 48,500 is 485 hours. And of course, 485 hours times $8. $8 must be standard, $8.35 actual. And what are the actual hours here? 3 what? Okay, jot these down. Actual hours is what? What is that? 360? Jot down actual hours, 360. Jot down actual rate, 8.35. Now let's find standards. Standard evidently would be 485. And standard would be $8. Now we've got both actuals and both standards. Alright, I want you to take your actual standards. We know this is hours. Now, how did I have that in the middle there? Did I have actual times standard? Is that the way I had it? Alright. See if you can do that and find me the overall labor variance, and then find me the other two variants, the rate variance and usage variance or efficiency. I'm going to go back and make sure what I wrote down is what I'm giving you. I reversed this on you. I had to go back and check myself. Oh, why it won't let me erase? All right, fill that in with those actual hours and standard hours. See if it works for us. Don't worry, we'll on it out Thursday if you don't get it today. We'll look at the problem. Okay, what was the actual times actual? I had you jot that down. Jessica, what was actual times actual?
I didn't get that wrote down.
Evan,
I didn't get it.
Alexandra, actual times actual.
I was writing down what it was.
360 times 8.35.
All right. 360.
Times 8.35.
Which one do we put first, Alexander? Quantity or price?
Put price in the first one.
Okay, at 8.35 and 360 was actual. Now down here, $8 was standard and 400 and what? 25.
85.
All right, Jessica, there's your numbers again, and you can get your total variance right here, which really is, you got to multiply both of those out to get your total variance. I'm trying to make it easier for you, but I might be mixing you up. I hope not. See if this works, guys. 835 times 360, 8 times 485. Well, something's wrong here. No, that's right. No, something's wrong here.
It should be 8 times 360.
The what?
It should be 8 times 360 for the year.
See, something's wrong right here. Standard is 8. 360, Jessica, thanks, yeah. All right, have you got the total variance? Anybody? How much? Now to get your price variance, it's 35 cents times 360. To get your rate variance, it's $8 times 85 plus 40, 125.
Why would the middle one not be 8.35 times 45?
Well, I might have got mixed up here somewhere, Alexandra. I don't know. Actual times actual. This is correct. Standard times standard. That's correct. Let's work these out and see what if our answers match. Okay. First off, 360 and actual was 360 and 385. All right. Did anybody get these figures? 126 or 1,000? You did, Kelly? Now, what's the total overall variance. Is that correct, 874? Now, did we get that? The way I set this up here, that's all I want to know. Now, right here, I want you to take, oh, wait a minute, something is funny here,
Yeah, I don't
Alexander.
get the 874 when I do it here.
No, something's wrong here. Actual times actual, standard times standard. Now that should work. When you multiply the actual times actual, standard times standard, and take the difference, you should get that answer.
874.
How much?
874.
Alright, you got that, right, Jessica?
Yeah.
Okay, that's what I want, and that's favorable or unfavorable. The difference, I believe it's favorable. Now, Jessica, did my ingredient sure work? 35 cents times 360 is how much?
I didn't use the middle part.
Alright, let's try it. Let's try the middle part. What is 35 cents times 360?
3,000.
Yeah,
How much?
3,000 cents.
How much?
$3,006.
$3,006?
Yeah.
Is that what they had? Alright, now here, what is $8 times, what's 360 times 485? $8 times 125 is how much? 8 times 125, is that 1,000? What? Alright, let me show you here. Here we're okay. We got the 1,000, right? Did you get the 1,000, Kelly? And here we're okay. We got the 874. But I did not hear the 126.
Oh, I got the one. Oh, I get it now.
Where is that 126? Unless you all told me something wrong.
The 126.
What is, Kelly told me 3,006, which I think's
Well,
ridiculous.
we did that. We did that 835.
Times 3.
Now I want you to take 35 cents times 360.
Is the 126.
One what?
126.
This formula works. If you'll help me with it.
Oh,
Now.
I got it now.
Okay. Now you ought to be careful. Multiply this out, please. And multiply this out, please. And take the difference over here. It'll still be 126.
Yeah.
A shortcut is taking 35 cents times 360, which is 126. This formula will work for you on all these variances if you will use it. Okay. Sometimes it's hard to get through to a hard head. But anyway, we'll do it. Alright. Now we're going to move on and look at overhead variances real quick. This will make sense once you do some homework, okay? Alright, now we've got to look at a little bit at overhead in the next few minutes. Okay? We got variable overhead and we've got spending variance. And we got efficient variance. Now, how many variances were there for materials? 3. Labor. 3. That's 6. Alright? And we have 4 for overhead. That's 10 variances, I want you to know. We looked at 6. Here's the other 4. Variable overhead spending efficiency. Fixed overhead spending efficiency. Alright, do you have these letters down? What's VOH? When you see that in your book, what is it?
Variable overhead.
Variable overhead. What is SVOR? standard variable overhead. And what is SH?
Standard hours.
All right, variable overhead, standard variable overhead times the standard hours. That's standard overhead rate. All right, how to calculate the total variance overhead? And we can make that shorter too. Standard overhead rate for variable is $4. Actual variable overhead cost, standard hours allowed per unit is 0.02. Actual direct labor hours worked is 1,500. Actual production is 500,000. Now standard hours allowed per unit is how much? Point what? 0.2. How many minutes is 0.2 hour? 0.02 of an hour?
1.2 minutes.
Very little, isn't it? Very little. Actual direct labor hours worked. Now, if you divided that by 0.02 hours, that'd be a lot of units. But we'll look at that in a minute. No, go ahead and divide 10,500 by 0.02. $10,500 divided by 0.02. What would that give you?
525,000.
I wanted you to look at that. How many units did we have? What was our actual production? How many? 500,000. But our standard should have been 525. Because if we spent that many hours, 0.2 hours per unit, we should have produced 525 standard, but we only produced 500. So we know that's an unfavorable variance. Now, will they put that into play? I don't know. Here they're taking the 2 cents times the 500,000 units, and they're getting 10,000. Yeah, they'd have to multiply. We're working backwards. Okay, so we take the actual overhead. Applied overhead is your standard rate. What's the standard rate? Standard variable overhead rate. Now, what was the standard hours? Oh boy, let's see where this will come from. Standard hours would have been 10,000. I worked it the other way. It said 525,000. What are we multiplying that by? Did we see $4 somewhere?
Yeah, 4 is your SVOR.
The what?
$4 is the standard variable overhead rate.
All right, thank you, Evan. So, standard hours is 10,000 times $4 is 40,000. So we have a total overhead variance, a variable overhead variance of $1,250. All right. Calculate the variable overhead spending and efficiency variances. We got the same information here. I'm gonna have to speed it up. All right, here are your formulas. We might can shorten those Thursday. Your spending variance is your actual hours times your standard variable overhead rate minus the variable overhead. Actual. actual minus standard. All right, your efficiency variance is actual rate minus standard rate times your standard variable overhead rate, which was 2,000. So your variance here would be 32,550 minus 2,000 is 1,250. All right, and that would be a total of favorable. So we're going to have to work on those variances come Thursday. So I'm going to count on you doing some of your homework. Use whatever formula you want, mine or the book, but we got to get down those 10 variances. We have not looked at fixed overhead variance, but it works the same as variable overhead. Pretty much. Okay, let me give you some assignments. I want you to read chapter 15 on ratios. Now, chapter 15 will be on the exam, but you can have that whole page of ratios. Now, we're speeding the end of this semester up so fast. I need to look at some problems on this chapter Thursday and look at some things on chapter 14. I may let you have open book on the exam. All right?
I'd appreciate that.
All right, I'll let you know Thursday. All right, let me put it this way. If you have your homework for this Thursday, you may get to use your book on the exam. If you don't have your homework this Thursday, there's no way you can use your book on the exam. Does that make sense now? Okay. So I encourage everybody to do their homework. Okay. Exercise 43, that is your standard quantities of labor material. That's still not getting into any meat of the chapter. 46 is your material variance. 47 is your labor variance. We'll try to practice another one in class, but you must practice these. It's important. We will not do the appendix journal entries on labor and material. I want you to try number 56 and 57. Overhead variances, variable and fixed. All right, those exercises are short. I just want you to do one possible problem. If I can find that problem. I don't see the problem I'd like to give you, so let me just give you problem 74. All right, you've got enough homework. If you do that, we'll learn these variances. Even if you have an open book on the exam, you need to know how to work these. Hope everybody makes it Thursday. I need to jot down any points for attendance and pre-restoration.